Alright guys, welcome back. I'm sorry this is coming later than I expected, but it's great to have been able to sort out the technical issues that I had. So today I'm going to be talking about something that I believe is going to be of help to everyone in the team and helping you pick some of the best entries that you can, because some of the questions that were asked were based on entries and the ability to pick more high probability reference points to operate with or from. And I'm going to be covering that topic, and I'm going to be using live examples or some of the examples that we traded in the previous week. And I'm going to be looking at them, and I'm going to be talking further on what I have today. So I'm going to be talking on picking high probability entry points. I'm going to be talking about that. I've actually covered this topic before, but then I'm doing this again, and I'm taking this a step further. And so here we go. As you can see, I've got some diagrams here that you can see. I'm gonna try to make sure everything fits in the screen. So right here we have two diagrams, and I'm gonna go further to explain what this means. In order for you to pick or trade with precision, you must understand how to pick high probability reference points, be those order blocks, fair value gaps, demand and supply zones, or your POIs and all of that. In order for you to operate with precision, you must be able to pick the best reference points. Reference points that are high probability, that would hold price and see a turnaround in price. And a lot of times I get these questions where, and that's the reason why I'm doing this and I'm talking about this. I get these questions where, the biggest questions out there would be, how do I know that this reference point would hold? How can I be sure? I mean, we've got three reference points. We've got a fair value gap on a particular range. We've got an order block. We've got or a demand or a supply zone. So we've got these reference points, and I'm a little bit confused on the one to pick. And I'm going to be talking about this. And after this video, at the end of this video, you would have a little bit more clarity on how to pick your reference points and the most probable reference points to work with. Now, it would take a little bit of your time to become very, very proficient in picking the best reference points. I'm not going to tell you that this video would really solve everything, but it would give you a head start, and you would be able to filter off bad reference points from the good ones, the valid ones from the invalid ones. So that's the point of this. And you would not have those questions. You'd be able to work and filter these ones out and work with the most probable ones. That's the essence of this video. So it's not in any way going to make this 100% for you, but you need time. You need to put in the time, you need to put in the effort, and you need to put in the screen time. There's no alternative to that. So basically we've got two diagrams here, or two representations that I've put out here on the screen, and let's get into it. Right now you can see that I have what looks like a market or price movement, as you can see. Now, if you look clearly in this particular price movement, you'd see that the market was making, or price was making, higher highs, higher lows, higher highs, and higher lows. Now, in such a situation, we would say order flow is bullish. All right. And that would mean that we expect to see higher prices going forward. Now, how would I operate if I were to trade this market? Now, the assumption that I have here is that this is, before we go further, I'm going to make this, I'm going to put this full screen mode. Now, the assumption here would be that this is a daily chart. We're working with a daily chart. You must always work with a daily chart if you intend to operate as a day trader or an intraday operator. So you must have the daily chart on. That's the very reference of our operations. So basically, we have the daily chart. We want to identify a structural type of price movement. We want to identify a particular type of structure, and then we want to isolate price. At the same time, we also want a situation where we could compare that price movement with the structure that we have, and then we can now fine tune further into the lower time frame, maybe the 1 hour time frame, and into the 15-minute time frame where we look for our entries, and we will find what I call the high probability reference points. Now, look at this right here. I want to take your attention to this formation or this particular structure. Now, I'm going to get to the rules in a second, but I want you to pay attention to this particular structure right here. Now, this structure is what we're looking for, but we want it to be within a particular type of framework. We don't just want to work with this or this or this. We want it to be within an already defined framework before we can go ahead to work with it or to pick that. So if we say we want it to be within a particular framework or a particular structure, what is that structure? That would take us to the rule. We want to look for the formation of a swing high to be broken. Now, in the case where we're looking at a rallying market, okay, we've identified the market to be rallying. We've identified order flow to be bullish. Now, again, this is the foundation on how to pick high probability reference points, be those order blocks, be those demand zones, be those your PLIs or your whatever it is you're looking for. Now, look for the formation of a swing high for a rallying market, that is, and we want that swing high to be broken. Now, if you look at this price pushed lower into this discount area and back again, it went all the way here. It broke the high. Now we have the previous high broken. Now, the second rule is we want to wait for the formation of a swing low. But that swing low should fail to break the previous swing low. So we had a swing low, but it failed to break this swing low. Now, we anticipate the attack of D3 by D4, and I'm going to get to that, up to T1 and T2. Now, on the daily time frame, once we have found that the previous low or the recent low failed to break the previous low, we've seen higher lows, we've seen higher highs. What would we expect? We would expect the trend to continue. We want to work within the trend. Now, we want a structure that looks like this. We want D1, D2, and D3, just like what we had here. We want candle formations that look like this. We're going to call this first candle D1. I'm going to call this second candle D2. And we're going to call this third candle D3. Now, after the formation of D3, we must make sure that it covers or totally engulfs the high of D2. It's very important. That's an unwritten rule. I failed to write that down, but you want to take note of that. We want to make sure that the entire body of D3 or the close of D3 closes above or totally engulfs the wick or the high of D2. Now, it would look like something like this. It would look like a brick. All right, that's what it looks like. So once that happens, we are now en route. We will be looking for D4, the formation of day 4, the candle 4. Now, when we look for the candle 4, we would anticipate that the candle 4 would attack T1. This would be T1. T1 means our target. And T2, that would be the second target. So we would expect price to trade higher, taking out T1 and T2. So basically, the formation of the new day would see price trading into, perhaps into D3, 50% or all the way down into maybe 60% of D3, and would be long from that area. Now, how do we know that? Because this is the daily time frame. At the end of D3, if you go to, and we're going to look at we're going to look at real examples just in a moment, but I need to explain this. When we see formations like this, the high probability entry points are going to be resting within D3 at the 60 all the way to the 78% of D3. These are the areas where you would find your high probability reference points, whatever it is you call them, order blocks or reference points. These would be the areas. So if we break this down to the lower time frame, we would find our entries, high probability entries. Price would fail to go below D2. That's another rule. Price would fail to go below D2. So if you are very conservative in your approach, you would, if you got an entry somewhere at the 68% or 70% or 80%, as the case may be, you could put a stop at D2. That is, if you are not in for the whole precision thing, and you want to have something that gives you a breather, or a stop level that gives you a breather, you can be sure that price would not go below D2. So the moment price, or the moment D4 starts, we would see price trading into the 68% or the 62% and the retracement area before targeting DT1 and subsequently, ultimately, T2. Now, having said that, we're going to look at the second example. Now, this is for a bearish order flow or a bearish marketplace. Now, I already told you what we want to look for, but we are not isolating what we're looking for, what you're seeing here. We're not just going to isolate that and look for that in any type of scenario or any type of market condition. It must be within an already defined framework. And that's where it becomes high probability. An already defined framework, that's where it becomes high probability. So if you look carefully, you'd find price was trading higher. It traded lower. Now we had a retracement. This would have been an order block or a supply zone. As you can see, price traded into it and traded lower. This was supposed to be a bullish candle, but let's forget about that. But then price traded lower. Look at the low. Now let's get to the rule. Look for the formation of a swing low to be broken. And we have that here. Now we wait for the formation of a swing high that fails to break the recent swing high. So we've got a swing high here. We've got a swing low that took out the previous low, rule 1. Rule number 2, we have a swing high that fails to take out the previous high to consolidate or solidify the idea that we are in a bearish marketplace. And coupled with the fact that we had this particular candle reacting to a bearish order block or a supply zone or a reference point right there. Now, reacting to that, it gave us this structure that I talked about. The D3 must close below D2. The low of D3 must go below that of D2. Take note of that. But it may not always engulf D1, as you saw here. D3 did not engulf D1. It doesn't have to be the case. In such a case, that's the reason why we target D1 as our T1, as our target one. In this case, it engulfed that entire body. So what would we be looking for? We would be expecting to see D4 trading back into D3. If we break that down into the lower time frame on the 15-minute or even the 30-minute, we'll find a high probability reference point right there in the form of the change in momentum, and we will get into that shortly. Now, as you can see, price trades back in there at the start of D4. This would be your very first target, and you could use this as T1. You could also use this as T1, but we use this as T1. Price would trade back in. It would open here, trade back in there, and all the way it goes, and targeting T1, and subsequently and ultimately targeting T2. That's the point of what we're doing, and that's what we're looking for. Now, having said that and having established that, I will now head for or go to examples. Now, coming back to the examples, like I promised, now if you look carefully, you would find lots of examples right here on the dollar Swissy. I'm not going to take too many examples. It would be your job to go back and study this, and you'd find hundreds of examples and why you can actually trust this, and you can always find your high probability entry points from this. Now, I'm going to use this to outline some of what I consider to be those examples right here. All right, I think I'm going to have to edit this. Here it comes. Sorry about that. And so basically, I'm here pointing out what I consider to be some of the examples right here. So you've got an example like this one right here. This is an example. We had price trading higher, giving us higher lows. As you can see, this low failed to take out this low. We were in a bullish marketplace right here. So you had this, the swing low. As you can see, this particular candle closed above the high, the close, or should I say the body of this particular bearish candle right here. So that's very important. And the wick high was also higher than that of the wick high for this one candle right here. Now this would be D1 and D2, and this would be D3. Like I said, we expect D4 to retrace lower and capture what I call a high probability reference point from that area before, taking off. So I'm gonna take the time now to mark that area. Where do we have D4? Where's the start of D4? It starts here. So we've got D4 starting here. So I'm going to go to the 1 hour time frame, and we're going to search for that area. Like I said, I'm not cherry picking this. You can actually go back and work this out yourself and look for multiple opportunities like this. And this sort of being the start of the new day. When doing this, I like to use MT4. Now we saw the high up here, but before doing this, I'm going to go back to the daily time frame so I can identify and point out our T1 and T2 before coming back to the hourly chart. So right here, as you can see, at the start of D4, this would be our T1, or you could use this. So we're going to be using this as T1. Here comes trading view once again. Okay. So this would be T1 right here. And we would have T2 around here. Basically what we're doing is we're using the highs of the previous daily candles as target areas for our entries. You can actually use this as T3. So this is your target 3. You've got 3 target areas that you want price to take out, and this would have been T3. I'm sorry about this. I always have problems with this, with trading view this way. And all right, I'm just gonna try to make sure this is straight. All right. Now let's go to, so we've got T1, T2, and T3. Now we're gonna go back to the hourly chart and look for that entry. It's not the straightest candle right there, but I'm just gonna try to make it. So right now, price traded higher. It took out these highs. It took out these highs. Now on the return, you're now going to ask yourself where this would have been during London. So London of the following day. So you'd ask yourself, what about this order block, or what about this order block, and what about this one? How do you differentiate and pick the right one? Folks are going to be like, well, what about this? Why don't I pick this? And 1, 2, 3, which of them would be the most probable entry for me? And let me show you how you do that. Now this is the entire range from here all the way here, and we're going to draw our fib to the top of the body of the candle. You could use the wick, but I prefer to use the volume. So all the way up here. Any reference point that you find above the 50% equilibrium should not be used, should be ignored. So if you have your reference points and you have any reference point above the 50% or just before the 62, the 70 and the 75% areas that we look for, you don't work with that. Now we've got this, and this interlaps with what we have here. We've got a load level here. What that simply means is that we've got a price, we've got a breaker here, okay? A change in the momentum, all right? This is what it looks like. A change in momentum would look like this. Now, we're not going to consider all these weeks. We're going to consider just the volume of the candle or the body of the candle. Now, look at this all the way here. It gave us what I'm going to call a load level. This right here is the load level before the break of this high. So I want you to draw that across. If you draw that across, you'd find that price reacted perfectly to that area. Perfectly to that area. Of course, you would have used this too, but this has more reason. This area has got more reason for an entry than just this. But we want to juxtapose and we want to see an interlap. What I'm talking about is we want to see a fair value gap, or we want to see an order block interlapping with the area where we found the change in momentum. When we find this together, and it happens in what we call a discount price, okay, because we've got two areas here. Any reference point that occurs above or above the 50% EQ, or just at the premium price for long positions, we do not consider those entries. We do not consider those reference points. If we're going to go long, any reference point that is above the 50 EQ or that is in premium price should not be considered. We only consider reference points that are within the 60, 70, and 75 retracement areas and in the discounted price area. Okay, if we're going to go long, because we want to see sponsorship, but we're not going to see sponsorship at premium price for longs. They are going to get it at the lowest price that they can find, and it's not going to happen here. It's going to happen at the discount, at a discounted area. And when you draw that and you find an area where you see the change in the momentum that was responsible for that particular rally or that particular movement in price, then that is the area that you want to consider for your valid reference point. When price begins to return to those areas, these are the areas that you want to consider. Now, you must also add a lot of the things that I've talked about. You're not going to take any one single thing that I've talked about in isolation. They work when they are put together in a defined framework. So you can't just isolate any of the things that I've talked about and try to use them independently. You have to make sure that they are together in a defined framework, the same way you see me doing. Now, if you used this area, you'd be more on point, and you would perhaps use your low. This would have been your stop. That would have been for 9 pips or 7 pips, or if you use just the body of the candle, 8.5 pip and 8.5 pip stop. And you can always go back and the moment price reacts, you want to go back into the lower time frame to look for some of the other things that I talked about in previous videos, and you can take the higher share or the higher volume of your proposed entry, and then you could do that. And I'm not going to go into that because you could go back to the previous videos and watch that. So basically, here's one example, and that's how you can actually pick your entries. And let's see, it took out T1 that very first day, it took out T2 and T3. It took out T1, T2, and T3, as you can see. So this would have been the start of the other day, of the next day, right here on the 7th, right here. And that would have been during London. So you'd have been long during London, and you'd have taken this all the way up. So now let's go back to the daily time frame. That's just one example right there. Now we're going to go to the daily time frame. We're going to be looking at some more examples that we took. There were trades that we took in the previous week, and we're going to look at those trades right there. And now, as you can see, we have this right here. This looks like what we are looking for, but we're looking at a trending market. The market is within that framework of a bullish rally, and that's what we want to work within. But then we also understand that this would be a very short-lived decline in price. And so we would not be looking to hold this for too long, but it would just be a very short thing. So a very temporary participation in that market in that way. So let's go to I'm going to mark that now. And that's the area right there. As you can see, like I said, I'm warning you, we don't use this in isolation. You can come here and look at this. This was a proper example. I'm not going to go into it because I do not want to waste so much of the time that I've allocated to this particular lesson. Now, this would not be the traditional type or the traditional framework to operate what I'm showing you right here. It wouldn't be. But then we understand that price would trade lower. Now it's time for us to go to the 4-hour time frame, and then we're going to go to the 1-hour time frame and look at this. On the 4-hour time frame, we find price trading here, and we had this is a load level. Price came back to react to that load level. But before doing that, let's go back to the daily time frame and separate D3. So this would have been D1, D2, and D3. So what we're here talking about, like I said earlier, is to find a way to identify the most high probability reference points that you can work with. I'm sorry about that. Now, let's go back to I'm gonna use the 1-hour time frame, and we're gonna break this down. So 30th of October, and we had a new day, and I want you to see what happened. We had a load level just around here. Price traded back in there, as you can see, reacted. We had price, I'm going to draw this down because I don't want to. All right. So here's the start. So we had price trading back here. We had another load level as a result of this break in that structure and the break in the lower structure. So that was a load right there. So I want you to draw this across. And I'm going to reduce. So we've got that load right there. This would have been the very first reaction. Second reaction and price traded lower. That's how you find this. Now, because we had this as our principle or our reason why we're looking for reference points. Now, any reference point that happens as we continue to break price down into lower time frame becomes high probability. Look at this. Price returns in here. It returns to this load level. It trades lower. It creates another load level right here. It trades back into it. It responds and takes out this previous low. Now, there's one thing I forgot to do. I forgot to mark T1 and T2. Now, this is something you can always do, and I don't always have to do that, but because for the sake of this class or this particular lesson, I will do that. So, okay, if we were to look at this, this would have been T1, T2, T3. But as the case, as you can see, immediately after that, this particular price took out every single thing. Let's just call this. Let's just call this the last target that we would have been looking for. So this would have been, let's call this T. I'm going to call that T1. Now you can take this and study what I'm showing you. I'm not cherry picking anything. It must be within the framework that I'm showing you. And you would always find this to help you pick the best reference points, the best order blocks, the best mitigation areas. These are the areas where those principles would work the most. So now I'm going to go to the 1 hour time frame. So this would have been T1. T2 was not attacked, but T1 was attacked and was cleared. And price returned back in there. Now, price returning in there, that was the day we took that particular trade. That was the last trade for the previous week, and that was the dollar Swissie. And price traded lower. It traded lower, and it took out this low, but failed to take this one out. And it traded back in, and as you can see, you're seeing the behavior that we have in here. But mind you, this isn't a bearish marketplace. It's not. So basically, I'm going to look for one more example on, I'm going to look for the buy examples. And all right, I think pound dollar was very okay. I'm going to be looking for buy example. So just go to the dollar CAD. All right. Now on the dollar CAD, if you look carefully, you'd find, look at this. That would have been, but that's way too far in time, so I'm not going to go into that. But this is a bullish marketplace. Look at the slow right here. This would have been a perfect example, but guess what? This was supposed to be D3, but we didn't get the requirement, or we didn't get it meeting the requirement that we would be looking for. But then look at this. What was supposed to be D4, we're going to count that as D3 instead. So 1, 2, and 3. This took out the high and this. Now we're going to use this as T1, our first target. I'm not cherry picking this. You can go and study this, but it must be within the context and within the defined framework that I've already talked about here, that I've already given you here. And this actually works for every other asset out there. Every other price action related asset right there, it works. So if we were to use this as terrible. We're going to use this as T1, and I'm going to be looking only for T1 here. So this is D1, D2, and D3. And I want to delineate, separate D3. All right. Okay, this is the start of D4. All right. I really want this to be I'm sorry if this is slow. Now let's go to the 1 hour time frame. Now it's now your responsibility to go and look for more options and more opportunities that looked like this. All right. So this was the end of that day. End of that day and start of the new day right here. So price traded higher, came back low, came back low. We want to look at the start of the movement all the way up right here. If we break that down, let's go. I think we should look at the lower time frame one more time. Okay, now this was the move up, price traded lower. We didn't get any real, because we're looking for buy opportunities. We didn't get any real reaction until the very next day. This was the 9th and this was the 10th. And most times you may have to wait. You may have to wait. Now, this would explain to you why sometimes I just have to wait. Now, if you come here, I think 3 days after, because this was the start of that other day, 8, 9, the 10th, and right here, it took a few days before, we found a structure that formed that showed a change in the momentum right here. Price traded higher, took out this high, it returned in there. But this entire move that we had here, that structure on the higher time frame has validated or did validate our search for longs. So now if I draw this all the way, this would have been that load level right here. As you can see, that would have been a really, really good entry right there. So in order to, I'm gonna bring in the day separator. And all right, I'm not seeing that, but okay, yeah, I think here it is. So this would have been 1, 2, 3, 4, I think the fifth day, the very fifth day. Now, remember what I told you, the area where you start to see reason, the change in momentum becomes the very, very high probable point to look for your entries. Now, what I'm showing you here, or what I've showed you here, isn't just the only thing, but it is also one of the, it's something that you could actually add to give you a certain level of, a certain layer of confirmation in your operations going forward. And this would have been T1. I'm sorry. This would have been T1 right here. And I'm going to go ahead now and take this off because I don't like having it on. So this would have been T1 right here, this high. Price traded in there, went back in the following day, traded higher. It just continued to give more opportunities into the next 3 days before it got ready and just boom. But when you do this and you see this and you see a change in a momentum that looks like this, you have a level such as this, as price continues to go to take out new highs, without taking this, you just keep waiting and you just keep re-entering. You find more opportunities and you can keep entering, keep going in for longs as long as you know you're within the right framework. If it's bullish, you want to be bullish. If it's bearish, you want to be bearish, and you could actually target this. And let's see how many pips that would have been. That would have been for 146 pips. But prior to that, you would have been able to take out this high. I'm talking about this high right here. That would have been 75 pips. You would have been able to take out this high, 83 pips. You'd have been able to take out this high, 64, this high, 84, and this 125. So you'd have had a really good run. And you know, I'm always looking for 50 or 60 all the way to 80 pips every week. And being able to do something like this with very good volume size would be amazing for a week of trading. And I would be willing to close trading operations after that. So basically, this is what I want to show you. I want you to go back and look at more opportunities and more examples that may have been presented this way. I want you to add this in with every other thing that you must have learned and every other thing that you must have seen me teach. And, you know, I'm not going to go into all of those, but try to recognize this as you go on. Look for this. Try to make sure that you're looking at the trend and the order flow. You want to understand and know what price is doing on a higher time frame, the daily time frame, and you'd be able to pick the best high probability entries. You must make sure that for longs, you're picking your entries at discounted levels, and for shorts, you're picking your entries at premium levels. And that's going to be it for today. I hope this has been helpful and eye-opening in some way. And I'll be waiting to hear your feedback and see how you perform as we go into the week. Have a good one, guys. And that's going to be it for today.